Personal income and some inflation data. We're going to be talking about that today during office hours with Professor Mark Guthner. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Office Hours with Professor Mark Guthner of Rutgers. Mark, how are you, my friend?
I'm doing quite well. I think our weather's going to finally improve here on the East Coast. We've gotten rain after rain after rain. I've had enough. But otherwise, things looking pretty good. Got no real complaints.
For those who normally tune in for the open mics, obviously we had the holiday to remember those who gave the ultimate sacrifice for the country on Monday. And then I was actually in Las Vegas, not to attend Bitcoin 2025 per se, but to meet with a number of people who were in attendance. And so I apologize for those that normally would have tuned in on Wednesday that we didn't have the open mic as we usually do. I was in Las Vegas for that. Not a lot of rain in Las Vegas. It's getting pretty toasty over there, I have to say. But yeah, that was nice. Very interesting to see all of that. So, what's your take on the economic data that we got today? Everybody sort of had their eyes open for this. We got the Fed's preferred measure of inflation, and just as a reminder for everybody, that's PCE, and specifically, I think Jerome Powell has referred to core PCE, and for some reason, my recollection is that he also has some modifications he does to that. I don't remember exactly what those are, but you had some thoughts about that, and I think you had some slides for us. I actually can pull some of those up on the Bloomberg terminal as well.
Yeah, so I think the economic picture continues to look good no matter what the folks are saying on TV or blathering about on social media. We got a number out today, or a couple of days ago, I guess. I don't remember what day, but U.S. trade. And we've seen a big rebound in U.S. Trade. And really, this is a reflection of all that massive pre-buying, pre-importing before the tariffs.
I have that actually up on my screen right now. Yeah. This is the U.S. trade and goods balance. Well, actually, you have the same. It looks like you have the same chart. This is Mark has a long-term chart, and if you're looking at you know what? Is my NDI running? I'm not. Okay, so well, that's good. We can show the chart that you have right there in the meantime while I figure out why my screen is not being shared here. That'll take 2 seconds.
So this is what I was expecting, that there was a bunch of pre-buying, get in front of the tariffs, load up on inventory. So we're kind of back to normal. That's going to be a boost to the GDP number because the trade deficit will be smaller. And so I'm we talked about this number, GDP last time. I was looking for a number with a 2 handle at least. And this part of the reason why, because I don't think domestically things are going to slow down, and the trade picture will be a boost, whereas it often is a drag. So I think that's a good thing. And then I wanted to touch on personal income, if we could. I think that's the next slide. So this number surprised me. I saw this one this morning. This was reported this morning. Personal income up 0.8% and up 5.2% year on year. So people's incomes are still doing well. So that's going to be a positive for GDP. If you think about inflation being something like 2.5%, and if it's year over year, and incomes are up a little over 5%, well, people there's a real growth in incomes of about 2.5%. That's a big positive. So that's another reason why I think the economy is going to be continue to do okay, that the momentum is still going to carry us forward. And then, of course, we got the PCE, which is the number you were talking about. just a moment ago. That number is creeping down. I think, I'd really like to know um, what the pundits have to say about this, because everybody was saying that we're going to have just horrendous inflation because of the tariffs. That's turning out not to be the case. It was not the case, or I made the argument as not the case because I think the economic thinking is wrong. When I went through uh, my economics class as a young cub, they taught us that if you put in a tariff, that means you're creating a price umbrella, and everybody else gets to raise their price under that umbrella. And that is perfectly true if you're talking about a commodity. So if you put a tax on import tax on, let's say, sugar or copper, that would certainly be the case, right? Because domestic producers, they're selling a commodity. And if you're taking the low cost producer essentially out of the market, then the person or the person setting the price, has a higher cost base. You're going to get a higher price. But in a broad economy, we have all kinds of substitutes, some of which will be domestic production. Some of it is, I'm just going to not buy that product anymore, or less of that product. I'm going to buy something else. And so that was the argument that I was making, that the fear of really high inflation, for that reason, is overblown. I'm an old monetarist, and it's my view that if you grow the money supply, then that's how you get more inflation. You get more money chasing a similar amount of goods and services. Price of the products are going to go up. So I actually think Jerome Powell is doing Trump a favor. Trump has been saying, you're not cutting rates. This perfect time to cut rates. I think he's doing him a favor, because I think if he started to juice the money supply, we would get the inflation, and he would get backlash from the tariffs.
So you think he's providing basically Trump with somebody to point the finger at for the things that he doesn't like, while keeping a lid on inflation,
Yeah.
which is obviously important politically as well.
Yeah. So it's just I try to game theory these things out and think about that. So I think he's doing him a favor. Whether he means to be doing him a favor specifically remains to be seen. But I think by keeping the money supply kind of tight, that is helping Trump out. And we see that in the Fed balance sheet here. If we go to the next chart, that the Fed balance has been shrinking its balance sheet. Now it's slowing down its the shrinking of its balance sheet. So I'm wondering if that is a signal that the Fed is kind of getting happy with where PCE is getting. The full index PCE is 2.1% year over year, I think you said earlier, before our conversation started. The core 2.5, but they're trending down. So maybe it feels like,
yeah, I have that on my screen right now. I don't know if that's actually working, but I do have this is also includes the contribution, so we can see that this is the core PCE year on year, 2.5%. Next one, by the way, we're going to get that on the 27th of June.
Mm-hmm.
So you can see that here, and you can see the respective contributions to it. So what's interesting here is that you can actually see, for example, the non-durable goods, very small contributor. Durable goods, you can see basically no net contribution at all. They have this component that they call supercore, but the biggest contributor is actually services. So this kind of goes to what you were talking about, that as people are thinking about the inflation picture, what's contributing to it, are tariffs really contributing? I wanted to just give people this one thing to think about for a moment on the tariff front. First of all, tariffs were very much on again, off again, right?
Yeah.
So they came out with these big numbers, and then there was a pause, and then maybe a more modest number, and pauses, and back and forth. So the real net effect of tariffs, we don't know what those would be. We only know what they could be.
Yeah.
Because we haven't actually imposed them in the truest sense yet. But I would like to give people this one thought. We know that for things like auto exports to Europe, that the average effective goods tariff that we are subject to, that is to say that if a Ford is being sold in the UK, is about 10%, and that ours was about 2.5% on them. So an increase of 7.5%. If you're trying to think about what the net effect, let's just say that we just said, okay, for simplicity, as an intellectual exercise, we're going to assume a 10% increase in tariffs overall. Well, we import about $4.1 trillion worth of goods from abroad.
Mm-hmm.
So the net effect of that, assuming that it did not pair those imports at all, which may or may not be realistic, but let's assume it didn't, is about $400 billion a year, right? So that's a 10% increase in across-the-board tariff assumed for all imported goods, right? Which has not actually been imposed, but even if it was, okay. So that's $400 billion of incremental revenues that's taking place on a $30 trillion economy.
Yeah.
And I think if people think about it that way, they'll begin to realize, hey, wait a minute, that's probably not going to be such a huge impact.
Yep.
And if at the same time you have some tax cuts, now whether or not the tax cuts that are in this bill that the Republicans just put out is good or bad, that's a separate question. But there is some measure of an offset. That is to say that you were actually making this point before, that the government has to collect revenues in the form of taxes. How are they going to do it? And what were your thoughts about that?
Well, the government's going to go grab some money. The question is, do you want to tax the productivity of people in the U.S.? So you tax labor, or do you want to tax consumption? And an import tax tariff, isn't it, is a tax on consumption. I don't like taxes of any kind, but if I had to say one is better than the other, I think a consumption tax is better because more or less people can decide if they're going to pay a tax by consuming. They say, I don't want to pay that tax. Well, grow your food in the backyard. Here's something.
Well, I guess provided you're not taxing the consumption of things that people really need,
right.
And we don't actually impose those on things like groceries.
Yeah.
So most states exempt things like groceries.
But that's right. So if you can manufacture your own product, you don't necessarily have to do it yourself. Maybe with 3D printers we could all be doing that. So to me it's a preferred way of taxing. So whether or not the rest of the world thinks that way, I don't know, but I would rather if they've talked about reducing income taxes on people making less than $150,000 a year. I think that would be a good thing if they're doing that. If that's the benefit of a tariff, that would be a reasonable trade-off to me.
Unfortunately, I'm not sure. So I haven't gone through it completely, but it looks like they're materially increasing the SALT caps.
Yeah,
that's the state and local tax deductions at the federal level. You live in New Jersey. I live in California. We obviously would benefit if we don't have to. Essentially, if the federal government subsidizes some of our local taxes, that's a benefit to us.
Yeah.
But I don't think it's good policy. So despite the fact that we get because what it does is it subsidizes behavior at the state and local level where government officials can say, hey, wait a minute, we can increase our own taxes, and at least a portion of that is going to be borne by a decrease in the tax liability of taxpayers to the federal government. I'm actually in some ways a little bit surprised that that's viewed to be constitutional, because one of the big problems when before there was an income tax was that there was this notion of apportionment, right? So the liability to the federal government by the states. And it strikes me that big SALT deductions end up meaning that a person who makes $1 million a year in one place will have a different federal tax liability than a person who makes $1 million in another place.
Yeah.
And that doesn't if that doesn't seem to be right from if you happen to live in Montana or New Hampshire or Florida or places that have lower taxes, and the residents of New York and California and New Jersey, people like us, are saying, you know what, the federal government needs, we're going to take more money from you because you've elected to tax yourself less locally, so we're just going to keep some of that.
Yeah.
That doesn't seem quite right. So I'm a little bit surprised by that. That's the first thing. I realize that there was tremendous pressure, and these are populated. New Jersey isn't New Jersey the most densely populated state in the country? I think it is.
It is. Yeah.
And California is the most populated state in the country. So maybe it's not surprising that politicians who live in these places are going to say, listen, we've got to do this because it's politically unsavory if we don't. But it does create some problems. It creates some asymmetry at the federal tax liability level, which I'm not crazy about.
It's also regressive because the beneficiaries are folks that are high income. Low income people are not affected, are marginally affected by the SALT cap. Maybe the middle class is affected a little bit by the SALT cap.
That's one of the reasons why this tax bill has been, by people who are opposed to it. One of the things that they're really highlighting is that it creates big tax cuts for the wealthy. But really, a big portion of those tax cuts for the wealthy are coming from the fact that actually they're going to be able to deduct the high taxes that they're paying locally.
Yeah.
And so it's not really being represented quite right that they, by increasing that deduction, what they're really saying is we're creating a big tax cut for the wealthy in blue states predominantly, isn't it? Isn't that really what's going on?
Yeah, and I'm a bit surprised that they're willing to spend so much money and continue on with the debt. We've seen some things here where a lot of the Doge cuts are not being codified. You just did all that hard work uncovering unsavory activity and borrowing money from our children to pay for it. And for whatever reason, the Congress hasn't stepped up and said, hey, let's get this under control. I don't like this idea of $2 trillion deficits for as far as the eye can see. I mean, that's got to create some kind of currency / interest rate instability over some period of time. Because
actually we are seeing that. We are seeing that if we take a look at the Dixie. So this is the value of the dollar, right?
Mm-hmm.
What we've seen is that there was a big strengthening of the dollar at first. I think probably because people thought, oh, are these guys going to start getting their fiscal house in order? And then as time passed, I think so we can see right here from prior to the election up until January, so after the election, the dollar appreciated by almost 10% relative to a basket of foreign currencies. And since that time, it has fallen to a level even lower than it was prior. Now, I was
Yeah.
talking to somebody about this yesterday. One of the things that I think is this isn't all bad, right? Because I think one of the things that Trump has said in the past, and I mean, like all politicians, depending on the audience, right? But one of the things he has said was that he thought the dollar was too strong because that hurts the competitiveness of U.S. manufactured products abroad. On the other hand, sort of the make America great or strong America, America first. It's also sometimes hard to reconcile that with a weak dollar, right? So I kind of feel like we're going back and forth on this. Where do you stand on all of this? And don't other major economies actually face similar problems? So shouldn't there be some bit of an offset? I mean, Japan, obviously, you were talking about the yen carry trade. Japan's long-term interest rates have been rising by scary amounts for such an indebted country. What are your thoughts there?
Yeah, so I think it's going to be a problem because the who owns those 40-year bonds, 30-year bonds in Japan? But it's the insurance companies and individuals and savers, and they've just taken a huge hit. It's they've taken a permanent loss in their capital of at least I forget the numbers we ran through last week, but what was that, 65%, I think, so far.
Mm-hmm.
And I would emphasize the word so far because I expect more than that in the years ahead. So that's not going to be a good thing for them.
So yeah, I have the Japanese 30-year, and as you can see, this is now essentially at 30-year highs. The rate on the Japanese 30-year government bonds.
Can you make that chart in terms of price?
Yeah. Let's see if I can. Well, there I would probably need to pick out. You know what? I'll do that on a separate screen. I'm going to pull out. I'll pull out a specific bond.
Yeah.
And then we can take a look at how that has actually done.
Yeah, because that's the scary part. Watching the rate is one thing, but when you actually see the impact on price, that's the scary part.
Yeah, yeah. Let's pull one out here. See what that one is. Here we go. So this should probably be, whoops, that didn't go onto the screen. Oh, there it is. Slow. So yeah, this is a 2064 bullet, and this is just how the price has changed just since, this is in less than a year. So in less than a year, this 30-year bond has gone down by more than 24%.
Wow. So that hurts. And that hurts because there's no get, you're going to have to wait 24 years or whatever it is to get that money back.
That money, and what the rates are telling you is that money that you're going to get back isn't worth as much.
It's not going to be worth as much. That's absolutely correct.
So yeah, I mean the truth is, I guess it's you don't recover is the short version.
Yeah.
That the only way for a person in this circumstance to recover the money that they've lost just since last August is for inflation and rates to really materially drop.
Yeah.
So that the value of this bond can appreciate. And I don't think that's going to happen because, we had a 40-year bull market for bonds, 40-year period of declining interest rates, and that fever has definitively broken. And, one of the things you were pointing out is that we could, in theory, if you really, if we had a Paul Volcker type of moment, that's the interesting thing, is that you'd actually need to see more pain in the short term to have the lower rates
Yeah,
in the long term.
yeah.
And I don't know that anybody has the stomach to do it.
No, nobody, no, the pain hasn't gotten bad enough for somebody to want to take some medicine. So I'd like to go back. We're talking about the deficit looking like it's going to be about 2 trillion per year for a long time. I think I gave you a chart of the savings rate, U.S. savings rate.
Mm-hmm.
And this is a remarkably small number. China built itself up, with savings rates in the 20, 30, and 40% kind of range for a long time. People had their income, they saved it, they bought property with their savings. They bought some kind of investment asset, stocks. And here we are. We're going to try to finance this huge deficit. And our savings rate is minuscule. How there's just not enough money there to finance both the government's deficit and new investment from the private sector. So this gets me very nervous that longer term, we're going to return to the money printer to bail ourselves out. And the government's got a perfect opportunity now to cut spending. The economy is in decent shape. The unemployment rate's low. And there's been a tremendous amount of announcements of investments by foreign corporations to invest in the U.S. They're manufacturing in the U.S. So I think we'll have a good jobs market for some time. And so this is the perfect time to start pulling away from deficit spending. The idea that people extrapolated from Keynes and his writings were that when the economy sucked, that's when the government should run a deficit, keep people employed, keep the economy sort of chugging along. And when there was finally recovery, run a surplus and then pay off that debt that you took on, or a big chunk of that debt. We don't do that. It's just now it's just a one-way street, and I can't see that as long term being healthy for us. So this is the only thing that has me nervous is the deficit plus the low savings rate. I suppose if our savings rate was really high, then people could buy the debt, and we could go on. But we're clearly going to need foreigners to buy the debt, and I'm not sure they're going to want to do that.
So actually, this brings up a couple interesting points. So first of all, I saw Larry Kudlow, former CNBC guy, former White House Council of Economic Advisors, was in the Reagan administration. I saw him speaking earlier this week about the fact that at least the good news is that 67% of the U.S. debt at the moment is held in U.S. hands. So U.S. investors have more than 2/3, maybe it was 68%, but it was more than 2/3 of the U.S. debt. So that was the first thing. Second thing, on this savings rate, you and I were talking about this before we went live, and one of the things I find interesting is that if you look at the savings rate, there is a bit of a bifurcation that the savings rate for median households rose sharply during the pandemic for two big reasons. One, people were spending less money, and two, there were transfer payments.
Yep.
I mean, people literally would wake up and the federal government, you had a bank account that was associated with your tax return where your refund checks would go. You look in one day and lo and behold, you got a stimulus check, and there it was. So people's balances went up, and they quickly spent that down. On the there are accounts, typically the very high net accounts, that actually have seen increases, substantial increases in their cash balances. And then the median and below households typically are seeing increases in net debt. So I guess I would ask you two questions about this. One, isn't it the higher income households that would be doing most of the savings and investment anyway. So even if the aggregate number isn't that great, it's possible that their percentage of investment versus consumption may rise. That's the first question. And secondly, what's the side effect of that? Because they are the marginal discretionary spending. It's the higher end household incomes that actually have discretion over whether they're spending it. And if they do more on the investment side, less on the spending side, 70% of the U.S. economy is consumer spending. What's the net effect of all of that going to be?
Well, I'm not one to get really concerned that people save, and that's slowing the economy, because we know that what happens if people save? Well, that money gets routed back into the economy through investment. So that savings goes into buying equity securities, or it's buying debt securities, and that creates economic activity. What causes the economy to slow down, and why the government doesn't like you to repay your debts, is that when you repay debt, that doesn't have any. That has a shrinking effect on the economy. Which is sort of what's the word I want to use? Unfortunate, because it does make sense to get your debt down so that you can spend more later. But the government likes, everything to move along nice and smooth, and then nice, instead of cyclic.
They want a metronomic sort of growth behavior.
But,
so tick tock, just the steady march. They like the steady march rather than ebbs and flows.
They like the straight edge.
Mm-hmm.
By virtue of the fact that people would be saving to buy the securities, and then the government spends the money, and that keeps the economy going along, that's okay. But as you know, my feeling on this is government doesn't spend money well or efficiently. That government spends money for political reasons, not for economic reasons, and therefore that's how there's nothing that the private sector can't do at a substantially lower price than what the government will do. They're not price sensitive economic actors.
Yeah, that's it is a little, well, number one, they're not price sensitive. Number two, a lot of government spending, as you put it, is politically motivated. So both of those are not significant positives. I think there's another issue as well, which is that almost every other actor in the economy has sort of a natural pairing function that they do to spending. And maybe they're not that efficient about it. So, for example, you or I, we decide to get a subscription to the Wall Street Journal, and we then get one to Investors Business Daily, and we get one to Barron's and The Economist and Financial Times. And at a certain point, you might, at the end of the month, look at your credit card statement and say, wow, that's a lot of money in subscriptions. And then you'll give it some thought. You'll say to yourself, am I really getting value for my Financial Times? Am I really getting value for the $4.48? I happen to have looked at, The Economist, because I might not have logged in properly, but I was trying to read an article in The Economist today, and it was like, to get a subscription. I was like, I thought I had a subscription to this, but it's like $4.48 a week or something is the after you go through the trial period. But one of the things I was asking myself was how many times do I actually read Economist articles? Because you also can get a certain number of free ones per month. That never happens in government, because there is nobody who's sitting there saying, I feel the pain. Somebody else bears the expense, and there is no accountability whatsoever. That doesn't mean that there's malfeasance, but it does mean that there is no forcing function, no corrective forcing function that exists in every other aspect. Every private enterprise has somebody who's going to pay a little bit of attention to that. Not everybody. Someone's like, I'll just expense it to my corporate card. But somebody in that chain has an economic incentive to try to curb that.
Yeah.
If it's your own credit card, you have an incentive to do that. But in government, there's none. There's nobody who's compensated specifically to try to save the taxpayers money.
Well, that's true, and oftentimes people profit for it. Well, I was going to say for you and I, we have something called opportunity cost. Opportunity cost is the most powerful economic force there is. I have $1 to spend. If I spend it on X, that means I don't get to spend it on Y. So if I'm going to spend it on X, X better be more valuable to me than Y. The government just says, well, let's just buy X and Y. So and then they go borrow the money, and then they drive over to the Fed, and they ask for some printed money, and they go spend it. So they're not subject to that.
Well, people within government also may actually get a benefit whether they use the product or not. They may actually have an individual benefit from having spent government funds as well. Now they have a relationship with their supplier or whomever. You buy some products from this business and from that business. You get out of government life, or who knows? Maybe they're junkets. I mean, there could be a million different reasons why. And some people like to buy things. There are a lot of people who go and shop for stuff because they like to shop for stuff. Spending money can be fun, especially if it's somebody else's.
Well, there's also the incentive problem. So I was listening to a podcast, and there was a lawyer, Colion Noir. I don't know if you know this fellow, but he took a look out there in California to say, where does $25 billion go?
Oh, actually, yes, I know who you're referring to. Yeah, sure. He's based in Houston. Yeah.
And really, really smart guy. But he went in and looked at why can't the government fix the homeless problem when they're spending significant, super large numbers of dollars, and he walked away, and actually the people that he was interviewing and talking to said the incentives are for the problem to get bigger and not smaller. Because if you're working for the government, taking down 250, 300 grand a year to address the problem, the last thing you want to do is solve the problem, because then you lose your paycheck.
Yeah, that's a great point. We see that here in the San Francisco Bay Area. I was just looking on the back shelf because I thought I had a copy of the book. Michael Schellenberger wrote a book about this exact issue.
Yeah.
It's called San Francisco.
Yeah.
And, it talks about the evolution over the course of more than half a century, frankly, of how the homeless problem in California, among others, but that's one of the ones that he focused on. And it is a land of perverse incentives that there's not a huge incentive to correct the problem. There's a huge incentive to be a part of the theoretical solution to the problem.
Yeah.
So it's become a business, and it's not.
It's a big business.
The homeless people are not benefiting from this business. They remain homeless.
Yeah.
And there's ever more of them. But examples also include, and actually this is a real problem here, how they do not try to solve the individual problems that some of these people face. So, for example, many of them are addicted to drugs, or they have psychological problems. Certainly in years past, after the Vietnam War, there were veterans who were coming back, and they were suffering from mental illness. And the way it is structured right now, correcting and curing those underpinning problems, helping to get people off of drugs, for example, that's not critical. So they focus on, servicing the population rather than curing the population of the underpinning causes of their homelessness and things like that. And it's quite sad, but it is not surprising. That does help it. If you look at the world with that understanding, you begin to understand how it's possible that a state like California has more than half the homeless population in the country
Yeah.
are in this state. And it has spent more trying to solve this problem than any other. And yet the problem has only worsened.
Well, you know, they say that no good deed goes unpunished. Um, and that's one of those situations. By the way, do we have any questions?
Well, no, we only have this comment, and I like it. This is from Tucker D. Dog. Well, first of all, I realize that we're doing these still as live streams, but it's not at the time that we usually did. So probably people who would watch it when it was at 2:30 Eastern are now going to be watching a recorded version, so they don't get to put their comments into the live chat. And so for those of you who are watching this recorded, just so you know, we had scheduling conflict at the regularly scheduled time that we used to have at 2:30, so we're now doing this earlier, and we're doing these at 12:30 Eastern time.
Yeah.
So just for anybody, if you hit the notification bell, I'm pretty sure that you will get a pop-up notification when we are starting a live stream in the future. So do that. But yeah, Tucker D. Dog, that comment was, the government says I have $1 to spend, then spends it, and then says, I need $1 to spend, and then just takes it.
Yeah, that's a good one.
Yeah, I mean, they spend it, they take it, they print it, which is still another effective way of taking it, as Milton Friedman would say, that, you know, you pay for it either through in an overt form by paying taxes, or through a covert form.
Yeah.
Through inflation. But he made a comment, which I encourage people to go and try to find, where he said there is no such thing as an unbalanced budget.
Yeah.
So, yeah. Actually, we have another one here. So the Andrew, he is asking us, what is a realistic price point for NVIDIA if China concerns are to continue? Yeah, so that's a good, yeah. You know, it's interesting. We tend to talk more about the big picture type of stuff, but I guess it would be reasonable to say that NVIDIA is kind of a big picture type of an issue in two critical areas. First of all, it's one of the most profitable and fastest growing companies that we have. The second is that they just reported earnings. So let's talk about the China impact. So there was $2.5 billion. Jensen said that there was $2.5 billion that they were goods that they were unable to export due to restrictions, and that the total net effect, I believe, was $8 billion. Still, despite all of this, I believe the number came in slightly better than expected. I wanted to talk a little bit quickly, and then I'll get your opinions on this, about the narrative that the company had. Let me see if I can blow this up a little bit so you guys can see it a little bit better.
Mm-hmm.
I'll scroll down. There we are. Okay, so we're right here, line 15. So, you know, when we adjust the numbers, it was basically a 2.8% beat. Obviously, the stock did a little bit better. It's a little weaker today. One of the things that they talked about, these are related. So we have these Chinese export restrictions, and a potential side effect of this is that not only does this mean that the Chinese are buying less products from a US-based company, we can decide whether we think that's good or bad, because I fully admit that there are actors in the world where we don't want them to have certain technology, so you might want to impose some restrictions on that. The most absurd example, of course, would be we're not going to sell nuclear weapons to terrorists who are intent to kill us, right? So that would be a very bad idea. I think we can all agree. There are various shades of gray, though, in between all of this. You know, for example, how do we feel about selling soybeans to countries that are not necessarily our allies, or who might even be our enemies? Well, we might not feel that that's so critical, and we might actually think that from a humanitarian perspective, it makes some sense for us to help provide food to people who need it, regardless of how we feel about their government. So in this case, we have a kind of a curious situation because, of course, we are in a global AI race right now. Mm-hmm. And this is a race we very desperately want to win. We also want to have a growing economy. We want U.S. companies to benefit. We have made it a stated objective of ours that we want to make more products in the United States and sell them abroad as much as we can. And here we have products that a U.S. company makes that another country wants to import, and we're imposing a restriction. So, there's a balance that has to be struck here. But the interesting thing is that when you impose a restriction, two things happen. One, obviously, the U.S. company is not going to be selling those goods, so they're not going to get those revenues. They're not going to see that income. But the difference is also that the would-be buyer is now going to be purchasing some substitute for what they can't get. So Huawei chips or whomever, they're going to get more money because their products are going to be purchased. They're going to have more money for research and development, which should, in theory, accelerate that research and development and accelerate their innovation and therefore narrow the gap between our technology and theirs. What are your thoughts on this?
Well, the way I would think about it is that, this is about governments just fighting with each other. So, but where are the incentives? So the Chinese government would prefer they could buy their chips from Huawei. So Huawei makes some chips that, or some other domestic chip manufacturer. So what a U.S. manufacturer would need to do is just create a chip that's a little bit better so that it's a superior product and people would buy yours versus them. So I don't know what that difference is, but if they bring it down to very close to what the domestic production is, then what they can produce domestically, then they're still going to get the business from China, and the world will go on. China will just end up with a chip that's not quite as satisfactory. Now, China has tried very hard to build chip manufacturing capability in the mainland. And for reasons I don't necessarily understand, they haven't been successful at doing that. Because they can go hire all the talent they want out of Taiwan and create the product. So they haven't been successful at doing that. That doesn't mean they're going to have that problem forever. They've got a strong incentive to get up that learning curve and do a brighter chip. So the question is do we still kind of do okay in the short run and then lose in the long run because you've created a strong incentive for them to buy or develop internally? We know that it's their practice that if they need somebody else's patent, they'll be more than happy to use it without compensation. So I don't think, if they say they missed out on $2.5 billion of sales, given their level of sales, I forget what their sales number is for the quarter. Mike, do you remember?
Oh, I'll get that. So we'll just pull that up right here. So that's annual. We want quarterly. So for the most recent reported quarter ending April, 44 billion, 62 million.
Yeah, and so the question is that a permanent loss of sales, or is that some sales is just going to get pushed off into the next quarter or two? So I don't see this as a huge negative for NVIDIA. They're going to find a way to create a product that is better than everybody else's. Maybe not as good as what the U.S. and European and now Middle Eastern customers are going to get, but they're still going to get a very good chip.
So, yeah, this is another interesting thing that Jensen said on the call. He did say that basically the gap between their technology and that of their competitors is narrowing. Somebody was asking me yesterday, they said, in terms of messaging, why were they making these announcements? Why were they, for example, saying, this was it's an $8 billion hit. that this is going to help their competitors, that their competitors, the gap is narrowing. And one of the things I responded with, I'll be curious to get your thoughts on this, is I said, if I was in public relations at NVIDIA, what narrative would I have provided other than that one? Because, of course, I'm trying to put out a narrative that, number one, is going to disclose to investors what's actually happening. But secondly, if at all possible, to try to encourage policy to favor my business. And to say, look, I mean, if I can explain that the gap between my products and those of our foreign competitors is narrowing, and that this is going to help those competitors catch up to what we're offering, then that might be a slight nudge, a little poke of the elbow to say, hey, maybe you don't need to be quite so restrictive. Maybe the best thing we can do is just, continue to innovate as fast as we can, and maintain our lead and sell as much of our products to our, to whoever wants to buy it as we can for as long as we can.
Yeah.
So there is a rationale, I suppose, to all of that. I think one of the things I saw out of all of this, just to go back to the original question, which is what's a realistic price point for NVIDIA if China concerns are to continue, is that the stock behaved, I think, as well as it did because I think investors' takeaway was that maybe the China concerns weren't quite as big as they had anticipated.
It's possible, and they're getting some shift. Now, listen, we had the Middle East say that they want to, have some data centers over there, whereas nobody even thought about the Middle East 6 weeks ago in terms of data centers. So, yeah, they lost something there. They gained something there. I wouldn't be surprised that we'll see more purchases of this hardware in Europe and in Eastern Europe because, they're part of NATO. They're part of, the European Union. They have plenty of market at this stage of the game. I don't see that they're at that end game yet.
So my thinking on this, and I wrote an article, I think I published it on the Options Edge website right after the earnings came out. If I didn't, I meant to, and I'll put it up. But for those who are watching, I'll just give you my high-level thoughts on this, which is that I think that between earnings announcements, it probably makes sense if you hold NVIDIA to consider writing some covered calls because you can get about 42.5, 45 vol for those options. It's kind of a tough one to do today with the stock down 4.5, but I think it was the day before yesterday or so that I put this out there. Sell some upside calls against your stock. I would not necessarily do that through earnings for two reasons, because it actually, ORATS, our friend Matt Amerson over at Options Research and Trading Services, he has pointed out that, in their work at least, and they have extensive back tests on this, that there isn't a huge amount of edge to be had selling covered calls through earnings because, a disproportionate amount of a stock's returns often come at that time. Yeah. So, the tailwind it creates in terms of muting downside is typically very modest, but the amount that it could clip your potential upside if the stock has a blowout surprise is just too great. So I think it's better to be more conservative, try to just navigate, collect a little bit of premium between the big events. Obviously you will still get assigned periodically, but in general you'll probably do better by that. I'm not bearish on NVIDIA here, and I wouldn't necessarily suggest that people should sell their stock at this point, because what we're seeing from the hyperscalers is that the demand is very high, and every single time people are saying, "Oh, they're going to pair it," and they're waiting to see some return on it, that doesn't seem to be what's happening at all. Yeah, whenever you talk to them, they reaffirm what they were trying to do. This is a really good question that we're getting here from Monday Morning Quarterback. How would you trade the Japanese government bonds to the downside? I don't know of a U.S. traded ETF or ETN that tracks Japanese government bonds. But I would say that if there are things that track the Japanese yen. And what typically happens when rates in a given area rise relative to the rest of the world? Usually that causes the local currency to strengthen, at least in the short term. And that's actually kind of what we're seeing here in the Japanese yen. What are you had some thoughts on the Japanese carry trade that you had articulated to me in the past. If you were going to try to play for, one, higher rates in Japan, and two, a narrowing of the spread between Japanese and, say, U.S. rates, Japanese and Bund rates, how would you play it?
Well, that was one of my concerns for U.S. markets. That could be like a black swan kind of event, where if there's a rapid unwind of that trade, then what's happening? People are going to be buying Japan and they're going to be selling the U.S. So it could be a scary situation here. I don't know a good way. Was never been a macro kind of guy for that kind of stuff, trading currencies, trading international government bonds. I've always been a stock picker in the latter parts of my career, the last 20 years or something. So I don't want to steer anybody in the wrong direction, because I just wouldn't be speaking to my strength.
No. So I mean, obviously that isn't 100% my area either, although it is something that we both, Mark and I, monitor because it does have important implications for money flows.
Yeah.
If you go back a year ago, when we first started to see sharp spikes in Japanese bond rates, what was the narrative at the time? All of the gnashing of teeth that was taking place at that time was about the unwind of what they call the yen carry trade. What is the yen carry trade? Well, if you're going to borrow money to deploy assets, what you would like to do is borrow money in places with very low interest rates in currencies that are likely to devalue relative to other currencies, because that reduces your borrowing costs even further, and deploy those assets into places with higher rates of return, higher interest rates in appreciating currencies.
Yeah.
So borrow in yen, low rates, deploy in the U.S., whether you're buying U.S. Treasury bonds, whether you're buying U.S. equities, whether you're buying other assets in growing economies. And the opposite, of course, is the unwind of the carry trade effect. So when we start to see the spreads between Japanese 10, 20, 30 years come in relative to U.S. Treasury rates, because we've seen our 10-year rates rise, but they have not risen as much, right? So what you'll end up getting is this effect, which is what we're showing here. This is an ETF that happens to track the Japanese yen, is that that's sort of the natural flow of money. So that would be one way to deploy it. I'll look into this a little bit further because it's interesting. I never really thought too much about how do I short the Japanese long bond. One of the reasons that I didn't is that people will say this isn't necessarily the case, but it is true that central banks and the treasury of respective governments, they do have some control over both the short and the long end.
Yeah.
And how and why would this be the case? Well, let's just imagine that there was tremendous pressure for rising rates in 20 and 30-year Japanese bonds. Well, Japan could say, well, we're not going to issue. We're not going to issue at the long end. We're going to issue at the short end. And then we're going to essentially have a QE program like we have here. And their central bank's balance sheet could expand and start scooping up some of the short-term debt. Also, there will probably be more of an appetite for short-term debt in any case globally. So now, of course, this is a very dangerous game to play because any money printing exercise, if it accelerates too quickly, then you can get into hyperinflation and complete loss of faith in credit.
Yeah.
But what we've seen is that government debt, money printing, expansion of the money supply, these things can persist for a very long time,
Yeah.
if they are done in an orderly fashion. Which brings me up to an interesting point at the Bitcoin conference, because of course I met a lot of people who were attending. Some of them were our age, of our generation, Mark. So
Yeah.
people who've been on Wall Street for a long time and are now trading and operating within the Bitcoin complex. And some were very young, 21, 25-year-olds. And those people were, pounding on the table, fiat currencies are going to collapse. And they were almost cheering it on because they were imagining that the sooner that happens, the better their Bitcoin investments would behave. And my response to them, it was during a dinner, I said, be very careful what you wish for. This is not something you want to have happen. You do not want to see hyperinflation, whatever your Bitcoin investments are.
Yeah.
Because hyperinflation is not just about currency, it's about political stability as well. And political instability, if you get wildly unstable currencies, political instability is likely to follow. And what we have seen historically is that things can turn very ugly indeed. So don't wish for that.
Yeah.
However much Bitcoin you own, don't wish for a collapse of fiat currencies. That's not what the world wants or needs.
Well, I would agree. You don't want a situation where your neighbor can't pay his bills, is hungry. That people will take to the streets. It's not a good place.
We saw in the pigs credit crisis, so Southern Europe suddenly saw rapidly rising problems. Greece, Spain, Italy. That was already exceptionally painful for them.
Yeah.
So, I would urge people to give that some thought before you start just saying, "Oh, I'm going to go Bitcoin and wait for the end." Hole up in my bunker and rub my hands together. We don't. None of us want this to happen.
When I went to Indonesia for the first time, I did some work for the country's largest life insurance company. It was 1,760 rupiah to the dollar. That's what I converted at the airport when I walked off the airplane. And during the Asian financial crisis, I remember walking into the office building that I was in and could convert at 20,000. This all took place in about 9 months. If I remember right, maybe a year.
This was in the mid-late 90s, right?
Yeah.
96, 97-ish?
Yeah, that was...
I was converting into Thai baht at that time. I remember I went to Thailand twice in that time frame. And the value of the baht to the dollar was cut in half between two trips that were less than 12 months apart.
Yeah, it was... and then, of course, what happened was all of a sudden there's a great deal of concern that people can't pay their bills, or, can't eat. It was becoming much more valuable to export your food, for example. So the government would put essentially an export tax on food to equalize their domestic, to make it for producers to earn the same amount, whether they sold overseas or domestically, because they fixed prices domestically, so that people could afford to buy some chicken, buy some corn, rice, and things like that. Palm oil was a big one, a big export product. So they put a tax on it so that the producers would earn the same amount if they sold it domestically versus internationally. Otherwise, they would have had a massive food shortage within the country.
So we just got a question here. Key takeaways from the Bitcoin conference in relation to Tradfi. So I'm assuming, are you talking about traditional finance here? I don't know that anything I'm about to say. So first of all, I didn't go to every single one of the things. I watched some of the talks virtually. I was there mostly to meet with some individuals who were there for other reasons. I think the key takeaway was that something that all of you watching already know, which is that the current administration is, basically much more on board, right? So what we're seeing is not just more adoption, but a much clearer regulatory and structural framework for how Bitcoin in particular could be potentially adopted. We saw Mayor Adams, for example. I thought this was interesting. He actually talked about bit bonds and that New York City was going to issue some of these. And, the question everybody was asking, behind the scenes is, are we going to see overt Bitcoin purchases for a reserve, as opposed to the process by which they're doing it now, which is confiscated Bitcoin lands in a Bitcoin reserve. Are we going to see some more aggressive policy prescription where, and then some, people were saying, should they print money to buy Bitcoin? Well, should they, will they, should they do this overtly? No, because that would actually accelerate exactly the problem that we were talking about. But does it make sense to have some barometer for hard money, for hard currency, I should say? Hard currency, hard money has a different context in lending, so I don't want to conflate the two. But generally that we have just better visibility. And as you sort of go down the track, it's going to get harder and harder for that to reverse. As more and more people adopt, as the structural frame, as the guide rails are more well-defined, and as institutional adoption increases, it becomes less and less likely that something comes along from the side and derails it all.
Yeah.
I think that at a high level is the takeaway. What were your thoughts?
I watched a fair amount online, and everybody's very enthusiastic because of adoption. Adoption's getting easier, and which is a good thing. And there's going to be some clarity in terms of taxation and things like that. Lots of high hopes for the stable coin. The stable coins are going to allow for a new payment method for instantaneous settlement, which will be a good thing. And that might really
great
hurt.
point. The settlement process and adoption in that area are very, very important and critical. Yeah.
Yeah, and that may really hurt Visa and MasterCard, perhaps American Express. They get a substantial fee, often 1 to 3%, sometimes higher, for which they take from the vendor, right? When they buy product, and that could get sliced down to 25 basis points, 10 basis points eventually. So maybe Visa and MasterCard end up with some challenges, and maybe they end up being a buyer of one of these Tradfi kind of operations. Maybe, who knows, maybe if they were smart, they've been building their infrastructure underneath the hood while nobody's paying attention, to have an alternative. So I know the Winklevoss brothers have a credit card that they offer, and a credit card product where, and I know that some others are, the cashback is not cash, but the cashback is in some Bitcoin. Some
that's an interesting. Yeah, it's interesting because one of the things. Look, I mean, it's not surprising at the Bitcoin conference, everyone's going to be an early adopter, but almost everybody I spoke to there had their fingers, their own personal finance, one way or another, involved with anything and everything in the space in terms of adopting the technology. So whether it was related debit and credit cards, that I was meeting with people who had invested in some of Grant Cardone's most recent real estate products, which are syndicated equity investments into commercial real estate investments, where the investors were able to elect to, instead of taking the dividends, they would actually automatically DCA into Bitcoin. And so I've met people who had done this, and I guess that election, he's now rolling out new products where you don't even make that election because there was such high adoption for people who wanted to automatically reinvest the income that the properties generated into Bitcoin, that the next ones that he's going to syndicate actually don't even have an election option. It all just goes automatically into Bitcoin, which I thought was very interesting. And one of the people just logged on to his account, logged on, showed me, here's how much the real estate is generating, here's the income, here's how much is being invested into Bitcoin each and every month, like that. So I thought that was very interesting. I don't know what the pass-through tax benefits, if any, are for this, but I'm sure that there are some. So also one of the questions we just got, which I'll ask you about, there's been, in relation to stablecoins, because you just referenced them, do you have any thoughts on the Circle IPO that is upcoming? So that's a pending.
I'm not excited about Circle, their economics, principally because either the majority or all of the interest made on the cash held behind the stablecoin is paid to Coinbase. So Coinbase might be the bigger winner. I remember reading in the prospectus it was 100%, but then I also was listening to a podcast, and then somebody in that podcast said it was less than that. It was 50, 60, 70%, something like that. So I don't know what the exact number is, but whereas Tether, on the other hand, is probably the most profitable company in the world now. Because when you've got billions of dollars and sitting in cash, it's really odd that it's against the regulation for these guys to pay interest. We've had a lot of because it's a security, and then they haven't set up the rules for the security. So these businesses are set up offshore, outside the U.S., and they keep the interest, and so. We've had discussions with the law department. So we have a meeting every day. Actually, at the time that we're doing this one now, but since it's the summer, we're not doing it. And we talked about stable coins as one of the topics, and that being a really big deal. That these operators are not in the U.S. and I couldn't understand, why isn't a stable coin just like a money market fund? You're just spending some money and you're getting interest on the underlying securities, and essentially because they don't have to, I guess.
Actually, it's also interesting, somebody that you and I both know who is looking at, is actually launching a Bitcoin complex hedge fund.
Yeah.
That is going to be doing things like statistical arbitrage within the complex. And you mentioned Coinbase, and one of the things that he mentioned, he's like, the fund is going to have to set up a Coinbase account. Not what you would normally think of, I guess, right offhand for like a hedge fund that was going to be doing stat arb in the space.
Yeah.
But it does highlight that they occupy kind of a critical role, so that kind of supports what you were talking about. We have another question that's unrelated, really unrelated. We're going from new economy concepts and new money concepts to one of the oldest. Steve B says there's been a lot of bullish CSX options trades today. Do you have any view on CSX or transports in general? I have a chart of CSX up, which happens to be bumping right against this 150-day moving average. I'm going to put this out to the 5-year here, and we can see that this stock's been essentially moribund now for the better part of the last half a decade. I mean, it's obviously up from the pandemic lows, but let's look at this from a pre-pandemic basis, just so we have that in there. But it hasn't been a great grower, but it's interesting because it's not a terribly expensive stock.
Yeah, what's its multiple, Mike?
What are your thoughts on transports here?
I think transports,
I think it's
the
trading about
rails
15 times
are
forward. Let me
perfectly
double.
fine. Since I believe the economy is moving along, that'll be just fine. I think some people are concerned that with less international trade, that there's less train activity from the coast into the center of the country. I don't, that's probably going to be offset in time with,
Well, you touched on that in the beginning of all of this by saying that you thought that some of those fears were overblown in any
yeah.
case.
And then I think as time goes and there's more manufacturing in the US, there's going to be more moving around of intermediate goods throughout the US. The cheapest way to do that, or the most efficient way to do that, is by rail.
Mm-hmm.
I think that's a safe place to invest your money.
Yeah, so we should. This is, by the way, Steve, this is a good highlight because just so that everybody gets an understanding of just how unusual this volume is. Okay, so this thing trades about 7,000 contracts a day on average. It has traded 55,500 call contracts today, and the bulk of that is in these. And this is opening, folks. The September 35 calls. We've seen more than 43,000 of those things trading. And implied volatility data suggests that these are being bought. Average price of about 72 cents a contract.
Yeah.
That's clearly an institutional buyer. If we take a look at the stock and you're saying, okay, well, where is 35 bucks just, in relation to the stock's most recent traded history, because as I showed you already, the stock hasn't moved all that much. That is basically suggesting that we get back at the very least to the highs that you saw in late 2024, because the stock was in fact over 37 bucks a share. So at 37.10, that's $2.10. That would be 3x what they paid for those calls if it manages to get back there, and that's in a shorter period of time. The thing that I was putting in here, I bet I'm just going to readjust this because our good friend Carter Worth, he likes to look at the 150, kind of a critical level. We're right there. And by the way, I double checked. It's actually closer to 16.4 times forward earnings. So there we are. You can see we're right at this level. Would I probably favor something like a call spread? Because I would expect we might run into a little bit of potential resistance if we get back to those prior highs right there. So maybe like a 32, 35. Plus, the fact that they bought all of those, the implied volatility on that strike went up by about 10 vol clicks. So, what do you think about like a 32, 35 call spread out to SEP?
That makes sense.
Or even a call spread risk reversal. The stock is only up marginally today, and some of that's almost certainly delta hedging. Let's just pull up as a concrete example.
Yeah.
Like a zero cost call spread risk reversal, I think. Yeah, and then we've kept everybody for a pretty long time, so we're gonna do this.
Correct. I think it makes sense because there's not a lot of downside risk. So selling a downside put to help pay for the call spread.
Yeah, I mean you're basically you're starting to draw a line in the sand after it's had some weakness. The stock's been kind of range bound over the course of the last 5 years. So we're going to just take a quick look. SEP call spread risk reversal. So I have an old version of options play, I'm being told. So you want to sell a downside put. So that's going to cost you. So this is the one they paid about 72 cents for on average. It's now about 73 cents mid-market. Sell that, buy these 165s, and then maybe sell a lower strike put down here. Like these 30s or something like that. That's going to get you into a small credit. Collect. This way you're not going to be paying out much decay, like that. So get a standstill rate of return. Worst case, you own the stock down, another 3.5%, 4% from here, or something like that. And actually, net of the premium you collect, what's going to happen is those wings will decay probably as a percentage of their value a little faster than the at-the-money call will.
Yeah.
So
How far did you
something
go
like
out?
this. I mean, you saw we just banged that out really quickly, but go ahead, Mark.
How far did you go out?
Well, I was just using the same expiration that they did. I was looking out to September.
Okay.
Yeah. So, I mean, that just happens to be where all the activity is. Why am I choosing the same expiration rather than choosing something a little near dated? I don't, sometimes you say, does somebody know something? I'm not suggesting, you've heard a lot of people say, what is the smart money doing? Is it smart money? I don't know if it's smart or not. But if they do have something very particular, in particular in mind, by choosing the same expiration, you're going to capture that.
Yeah.
And then you can, you'll at least, it's a good placeholder trade as well, because you can then spend a little bit of time and do a little bit of additional work. And as you pointed out, the valuation's not terribly unreasonable here either. Okay, so with all of that said, we have chewed up well over an hour of the time of those of you who either watched it live, and I know there's a couple of you, and those of you who will be watching a recording. Like, subscribe, and hit the notification bell. And as I said before, because Mark's time is actually going to be chewed up at the time that we used to do these on Fridays by his other obligations, we're going to be doing these at 12:30 Eastern going forward. That's when open interest office hours will be taking place. Please put in your comments, questions, and we'll try to get to them in a future video. Thank you, everybody, for watching, and have a great weekend.
See you, Mike.